Mining giant BHP has slashed its dividend after commodity prices fell sharply during the financial year and inflationary pressures pushed up costs. Joining me now is business reporter Edward Boyd. Ed, BHP's profits slumped about 40%. What about the outlook? Because those prices will be crucial, right? What they're getting for what they're digging up.
Yeah, look, the big factor here with BHP and all mining companies for that matter, Tom, is the outlook for the prices of all the commodities that they dig up. In BHP's case, it's the largest company on the ASX 200, worth about 12% of all the shares on the Australian stock market. Here's the general results. You can see lots of everything went down during the last 12 months. Revenue was still almost 54 billion US dollars. Underlying profit about 13.4 billion US, down 37%. The statutory profit, which included some write-downs, was down almost 60%. The final dividend, 80 US cents per share. That is about 95 cents lower than the same time last year. However, it's still one of the strongest dividends BHP have ever paid out. Here's what happened with commodity prices. This is the average realised price that BHP received for the commodities that it sold during the last 12 months. You can see iron ore was down about 18%, copper down 12%, metallurgical coal pretty strong at 271 US dollars a tonne, but that was still down 22%. Thermal coal went up and nickel was up as well. In the BHP's results today, they also talked about the amount of royalties they've been paying additionally to the Queensland government, which was 700 million US dollars during the last 12 months. This is the share price reaction to BHP's results. You can see only down about 1.13%. So stock markets clearly digest them and sees a lot of upside still to BHP's position. They are expecting prices to remain reasonably similar to what they've been over the past 12 months, over the next 12 months, Tom. So the iron ore price is probably going to be sitting at around 80 to 100 US dollars a tonne, probably around the 90 to 100 kind of level long term. So at that price, BHP is still making good money. They're still paying big dividends to shareholders and still paying billions of dollars in royalties to governments like the Australian government.
Meanwhile, coal's a profit of a lazy $1 billion. Now, it lifted prices almost 7% during the year. I'm sure this is going to set more debate running around how much supermarkets are profiting, versus actual inflation they're copping. Exactly.
Look, these are the results for the full year for coals, which ended on the 30th of June. And we know in the year to June 30, inflation increased 6%, the CPI index across Australia. So coals did lift their prices by 6.7% over that same period. So they lifted their prices a bit more than what inflation was. Revenue, you can see there, went up about 6% to $40.5 billion. Net profit was basically flat when compared to the year before at $1 billion. Final dividend remained flat at 30 cents per share. But just have a look at the share price reaction if we go to the next slide. Coles has been punished on the market today. They're one of the worst performers. Investors clearly not happy with the dividend being where it is, and the outlook for prices. Coles have basically said in their results today that prices are going to continue rising. They're going to keep lifting prices with inflation, but they are saying some of those big supply chain issues and cost pressures that they've been seeing are starting to come off, but obviously they're not coming down as quickly as anyone buying food at the checkout would like. Here's the stock market today. You can see basically flat, down 14 points, and I think a lot of that is due to BHP only falling 1% because it does make up such a large portion of our stock market. When it has a bad day, the market drops. But coal's down for about 5%, and they're down roughly 16% over the last 12 months. So it's been a tough 12 months for a coal's shareholder, Tom.
Yeah, albeit taking a bit of cream off the top of those price rises. Ed, thank you.